All right. Today is Thursday, March 4th, and this is a post-market review for the stock market activities today. Obviously, we had a massive red day across all indices, but specifically for technology and growth stocks. So we saw the bulk of the pain taking place in the Nasdaq. We started the day anticipating Federal Reserve Chairman Jerome Powell's interview with the Wall Street Journal. And the market was anticipating a reaction from the Federal Reserve Chairman. The market was anticipating more clarity and perhaps a specific response to calm down inflationary fears. We know that the propaganda tour that the Federal Reserve been on since last week did not work out, meaning that the Federal Reserve personalities went on a tour attempting to calm down inflationary fears by telling us that inflation, even if it happens, it's just transitory and yields are rising due to quote-unquote good reasons. The economy is heating up. Matter of fact, it is so hot even before we start the reopening phase in the economy. Savings rates higher, the majority of economic indicators are very decent, and the outlook for the economy, at least in the very short term, is very, very bright, because the expectation is that once we reopen the economy, we will see all of that pinned up demand unleashed all at once into the economy. People booking vacations, going out to eat, going to concerts, organizing events, flying more, and that would stimulate the economy to recover significantly faster, and we will perhaps see a period of rapid growth in the economy. So what is the problem here? Why is the stock market throwing a fit? The reason is that yields are not really rising for the good reasons, as the Federal Reserve is saying. Yields are rising due to inflation expectations. All of this liquidity has been ushered by the Federal Reserve, and the federal government is creating a lot of inflation in the economy. And the bond market is saying, wait a minute here. Yes, we might have an economic recovery underway, but we also have high inflation. Just look at commodity prices. And therefore, we demand higher yields on treasuries, and therefore you're seeing yields climbing higher and higher. And as yields continue to climb higher and higher and higher, what happens? The stock market, specifically high growth, technology, high multiple names, they go down. Why is that? Go back to your financial classes, and even if you did not take any financial classes, just understand that in any financial calculator, when you try to calculate future earnings, you have to factor in interest rates. Well, if interest rates are higher, that dilutes the value of future returns. High multiple stocks in the technology sector and momentum stocks such as Tesla and the likes, they don't have a lot of earnings right now. Market participants decided to give these names high multiples based on future earnings. Well, when yields rise higher, those future earnings get diluted in value, and you have to price these stocks lower and lower. Today, it was Jerome Powell's turn to slow down or even stop the rise in treasury yields rates. And since the propaganda did not work, the market was expecting actual policy. For example, what we discussed in last night's video, Operation Twist, in which the Federal Reserve will switch their bond purchases from the shorter end of the yield curve. We're talking about the monthly to the 1 year, 3 year treasuries, and they will switch that into buying the 10-year plus treasuries, and that would calm down the rise in treasury yields and stabilize the market. We did not get that today from Jerome Powell. What we got is more of the same. Him denying that inflation is a problem at all, denying that inflation exists in any worrisome level, and even if it is, he believes that inflation will be transitory, meaning only for a short period of time. The market did not like the fact that Jerome Powell did not offer any assurances to tamper down inflation expectations. Now, there is a lot of confusion going on in the market right now and even within quote-unquote market experts in terms of explaining what's going on in the market. So let's step back and take it one step at a time. Going back all the way to last year, specifically the month of February, we got the news that the COVID-19 virus is in the US and we are already experiencing community spread. The market panicked and we saw a massive sell-off in a rapid manner. We knew that we are heading into a massive economic crisis that could rival the likes of the Great Depression from last century. So the Federal Reserve had to do something. And what they did is ushering the tsunami of liquidity, trillions and trillions and trillions of dollars into the system, making sure that corporate America will not have any problem getting cash to keep employees on the payroll and not suffer bankruptcies and mass unemployment problem. The Federal Reserve overdid the tsunami of liquidity in addition to the stimulus coming from the federal government. So the fiscal and monetary side working together to make sure that the crisis is not going to morph into a Great Depression-like crisis. But the problem is that this created two sides of the recovery, the haves versus the have-nots. The haves are corporate America and white-collar workers who had the luxury of keeping their jobs and working from home. Corporate America, if they have any collateral, they would have access to the Federal Reserve's lending facilities, meaning that they can offer any collateral and they will get cash on demand. So if corporate America is not going to have any problem with cash, the assumption is they're not going to have to fire a lot of workers and we're not going to see any liquidity problem in the market that leads to bankruptcies, etc. Mission accomplished. We did not see a mass wave of bankruptcies and we did not see a massive unemployment problem, at least it was in the beginning, and then it recovered quickly because the abundance of the liquidity from the Federal Reserve. Likewise, with all the stimulus going on in the economy, the white-collar workers who managed to keep their jobs and work from home, well now they don't have to go out to eat, they're not spending on vacations, concerts, etc. So their savings rate went higher and higher. They have a lot of cash. In addition, they received a lot of stimulus money from the federal government. And we had a lot of concerns back then that the tsunami of liquidity could have unintended consequences. But the Federal Reserve said, don't worry about that now because we will worry about that later on. For now, we need to rescue the economy. Okay, now here is the problem. The have-not side of the economy, Main Street, small businesses, and blue-collar workers who lost their jobs. Small businesses got decimated. They had to let go of a lot of employees, even though we had a lot of programs to help them out, such as the PPP loan program. But the health crisis extended further than anybody expected, and we saw delays in new rounds of stimulus, etc. Anyways, the result is we saw a complete decimation of the small business side of the economy, and therefore we saw a lot of unemployment from blue-collar workers, small business workers, leisure, hospitality, restaurants, etc. So now we have an uneven economy with one side having more cash than ever. The pandemic was the best thing that ever happened to them from a financial standpoint. And then we have another side that is still struggling to recover. We also saw another phenomenon because the abundance of liquidity gave a lot of people extra cash to do whatever they want to do with it. And since people are staying at home and there's nothing to do, they discovered stocks trading, options trading. Remember, they have a lot of extra cash now. They're saving a lot and they received a lot of stimulus money. So a lot of that money found its way in the stock market. And since retail participation in the stock market is not very educated and they're only relying on the fact that the Federal Reserve has their backs and will support the equities market no matter what. That emboldened retail investors to take a lot of risk by buying stocks of companies with no profits and sometimes not even revenue. They're just investing based on the sexiness of the name. Buying Tesla, buying this, buying that, didn't matter. The SPAC mania, we saw a massive speculative frenzy in the stock market since the March bottom to insane levels where stock market valuations are now at extreme bubble territory, meaning that the have side of the economy, remember, they have high savings rate, they received a lot of stimulus, and now their stocks are very profitable. So they have a ton of cash and they want to use that cash for what? Once we see the light at the end of the tunnel regarding the pandemic, we are vaccinated, and things start to return to normal, all of that tsunami of cash from the half sides of the economy will go on into spending, going on vacations, eating out, flying more, cruises, concerts, events, lots and lots of spending. Why? Because they have a lot of cash. So that is good for the economy, right? Yes, it is. But you have to remember something. All of that tsunami of liquidity was concerning from the very beginning for being too excessive. But remember what the Federal Reserve said. Now it's not the time to worry about the consequences. That comes later. Well, we are now in the later part. Why is that? Because all of that tsunami of liquidity is creating massive inflation. When you have all of these people waiting to stampede once we reopen the economy to spend their money, that would create lots and lots of inflation. From an economic standpoint, we call it the money supply. The money supply skyrocketed in a cartoonish way. This is the trillions and trillions of dollars from the Federal Reserve and the federal government flooded the system. Historically speaking, when we see a surge in money supply, that is always followed by an increase in inflation. This time around, everybody was convinced that it is different because of the de-inflationary pressures, etc., etc. But the missing formula was the velocity of money. What does that mean? It means how fast does the money exchange hands in the economy? Well, right now we're in a lockdown in most places, so we're not exchanging that cash all over the place. The velocity of money is still very, very low. But once we reopen, the velocity of money will accelerate significantly, and that will lead to a massive surge of inflation, given the level of M2 money supply. But hey, we have not reopened yet. What's going on here? Why is everybody worried about inflation when we haven't even reopened yet? Here is the problem. Remember that the market looks forward, not backward. And when it looks forward, it sees a massive recovery in the economy, but also coming hand in hand with massive inflation. Now, connecting the puzzles all together, specifically in the bonds market, investors are saying, watch out, our inflation expectations are very, very high. We are not going to buy treasuries unless the yields can keep up with our expectations of the high inflation that is about to come. And therefore, you're seeing treasury yields pushing higher and higher and higher. And I've already explained to you why higher yields crush high multiple stocks in the technology and growth sector of the market, because their current valuations at extreme bubble territory is based on future earnings, the future bro. Remember? Well, now you have yields rising higher, interest rates going higher. That means that those future earnings have to be diluted in value. And you're seeing stocks like Okta, Tesla, Zoom, etc. suffering tremendously. And here is what you're going to say. Wait a minute, Maverick. If the economy is healing faster and sooner than we expect, and we are about to reopen and everything is hunky-dory to combat all of these inflationary fears pushing yields higher, why doesn't the Federal Reserve slow down the tsunami of liquidity? Meaning, the mission accomplished, now you have to cut down on all of the stimulus from both the monetary and fiscal side of the government, because we're already healing. And more spending, more liquidity will only lead to higher inflation. Well, Jerome Powell told you repeatedly and specifically today why he's not pausing the quote-unquote easy conditions for the market. These easy conditions are the reason behind the surge of inflation expectations, which is the current problem in the market. Here is why Jerome Powell doesn't want to take his foot off the pedal. Back to the have and have-nots. Remember the have-not side of the economy? Small businesses, Main Street, and all of the unemployed workers? Well, the Federal Reserve believes that if they continue the easy conditions and flooding the system with more and more liquidity, somehow that will trickle down to small businesses and the unemployed, and we will recover the employment picture in America. What Mr. Powell is not factoring in is the fact that the reason behind the high unemployment rate and the destruction of small businesses is the virus and the lockdowns that resulted from the virus. And you cannot throw more money on that problem and fix it. You have to wait till we heal from the virus and we are vaccinated and we are ready to go back to normal life, and then things will recover on their own. But this is not how Federal Reserve Chairman Jerome Powell thinks. He believes that if he continues to flood the market with liquidity, somehow that will recover the employment picture. The result of all of this is more and more inflation expectations. In addition, the upcoming new round of stimulus from the federal government. So we have more and more and more tsunami of liquidity that is about to hit the system. That will push the economy to overheat because now the demand will surge higher and higher and higher. Meanwhile, the supply is still struggling to keep up. Inflation rises higher. What does that mean? Yields will continue to rise higher and higher and higher, which also means that these technology stocks, growth stocks, will continue to suffer and suffer and suffer until we reach a point where all of these inflationary fears subside, or we reach massive correction in these overvalued names and the market decides that now is the time to buy the dip because the valuations are not frothy anymore. Where is that point? We don't know. What we know is that Jerome Powell decided to do nothing. In essence, Jerome Powell said, short the hell out of the market. This is what I got today. Why? Because he said, I'm not going to do anything regarding controlling the rise in Treasury yields. What does that mean? It means that there is more pain to come in these high-valued names in the stock market, the Tesla and the likes. This is what I got from Jerome Powell's interview today. And this is what the market got. The market got, wait a minute, he's not going to do anything. Inflation is going to get out of hand, and therefore we'll demand higher yields in the bonds market, and we will sell these high multiple names in the stock market because they're not attractive anymore when you factor in the rise in Treasury yields and the rise of inflation expectations. So I hope this is clear for you. I don't mean to go on and ramble about this subject over and over again, but I know that we have new investors who are confused with what's going on. So I hope that my explanation was helpful to you. Now, here's the other point. Remember back last year when Jerome Powell was asked about the high valuations in the stock market and how dangerous that could be, specifically if we see a rise in inflation, that the PE multiples in the market are so high. Remember what Jerome Powell said? Jerome Powell said, don't worry about high valuations in stocks. Don't worry about that at all. Why? Because the risk-free rate, aka Treasury yields, are very, very low. And therefore, you don't have to worry about valuations anymore. Put your blindfold on and continue to buy. Of course, he didn't say all of that, but this is what we extracted from his statements. And here is his statement precisely.
You know, financial stability, we look at a broad range of things. We actually have a framework so that we can, evaluate changes in financial stability over time, and so that the public can evaluate whether we're doing a good job at it. So what do we look at? Asset prices is one thing that we look at. And, we published a report a few weeks ago on that. Maybe it was a month or so ago, anyway. And I think you'll find a mixed bag there. It depends. With equities, it depends on whether you're looking at PEs or whether you're looking at the premium over the risk-free return. If you look at PEs, they're historically high, but in a world where the risk-free rate is going to be low for a sustained period, the equity premium, which is really the reward you get for taking equity risk, would be what you'd look at, and that's not at incredibly low levels. So, which would mean that they're not overpriced in that sense. Admittedly, PEs are high, but that's maybe not as relevant in a world where we think the 10-year Treasury is going to be lower than it's been historically from a return perspective.
And of course, I made a video back then saying, be careful of trusting Papa Jerome, because all of market participants, the gamblers, the Robin Hoodists, the maniacs who are chasing this bubble said, oh, we don't have to worry about valuations because Papa Jerome got our back. And Papa Jerome just said, buy the market. And I said, be careful because Papa Jerome is going to stab you in the back. Matter of fact, the title of the video was, The Fed Says Keep Gambling, Offers No Insurance. And back then I said, the Federal Reserve is saying don't worry about the insane valuations in the stock market and continue to gamble because Treasury yields are still low and will remain low. And I told you back then, don't trust this son of a bitch. Papa Jerome will stab you in the back, and today he stabbed you in the ass. And the reason is the Federal Reserve has no control over the long end of the yield curve. So he's saying don't worry about the valuations because the 10-year Treasury yield is very, very low. Well, now the 10-year Treasury yield is high or higher, and that surge in yields happened rapidly in a matter of weeks because inflation expectations continued to surge higher and higher as we get closer to the reopening phase. And now you know. I warned you not to trust Jerome Powell and not to buy all of these high-valued stocks, because if we see the slightest bit for rise in Treasury yields, then the whole argument that you don't have to worry about high multiples and high valuations, just put your blindfold on and buy, that argument goes out of the window. Because remember, before you had Tina. There is no alternative. And I told you back then that Tina will break your heart just like she did back in high school. This is exactly what's going on right now. Because guess what? A 1.5%, a 10-year Treasury yield, well, that is an alternative. And it is a risk-free alternative. Now, for you and me, retail investors, 1.5% is nothing. But you have to remember, me and you don't control the market. It's the BlackRocks of the world, the Fidelities of the world, and they have massive funds, and when the S&P 500 yield is lower than the risk-free rate, all of a sudden the stock market is not attractive to be in anymore. Once again, I apologize for the lengthy explanation here, but I thought that this is important to start with. We're going to talk about this and a lot more during the headlines of the day segment. But for now, I got a market to cover, and here we go. The Dow Industrial Average closing in the red, down by 345.95 points, or a decline of 1.11%. The Nasdaq leading the declines, down by 274.28 points, or a decline of 2.11%. S&P 500 also in the red, down 51.25 points, or a decline of 1.34%. What about the sector's performance for the day? Coming up at number 1, per usual, and capturing the gold, silver, and bronze, energy. Meanwhile, the rest of the market closing in the red, pathetic performance across the board. The decliners led by materials, technology, and cyclicals. Now, here's an important point, so pay attention. Why is energy closing in the green while materials closing in the red? Shouldn't materials and energy both benefit from inflation or high inflation expectations? Yes, you are right. But we also have another phenomenon going on in the market, which is the rise of the US dollar. The dollar going higher, we will see profit taking in materials. What's keeping a floor under energy is the event that we saw today from OPEC, and OPEC is still firm. They're not going to increase the supply. And that is helping energy prices to continue to rise higher. Speaking of, let's go ahead and cover the futures market. What do we see here? Crude oil, massive gains, over 4% for both the WTI and Brent. Massive gains, and the energy trade remains hot. What do you think happens when crude oil prices rise higher? More and more inflation. This is what the market is worried about. Jerome Powell and the Federal Reserve is saying don't worry about inflation, because yields are just rising for the quote-unquote good reason, because we're about to reopen the economy. But the market is not stupid to believe that bullshit. The market is looking at what? It's looking at crude oil prices, lumber prices, grains prices, and it's saying, wait a minute here. We have commodity prices surging significantly higher to the point where Goldman Sachs and the likes are calling it a commodities super cycle. Well, commodities are input prices for corporations. If input prices go higher, in addition to the minimum wage, etc., then they're going to have to pass that extra cost back to the end customer. Some companies are able to do that, and they will thrive, but passing the cost to the end customer will also contribute to higher inflation. Other companies will not have the luxury of being able to pass the extra cost to the end customer. These companies will suffer. Their margins will shrink, and therefore their stocks will trade lower and lower. What do we see here in softs in the futures market? Lumber, back to the green. The Federal Reserve tried to talk lumber prices down. It worked for a couple of days. Now we're back in the green, baby. More and more inflation. Sugar slightly in the green, but we saw declines for coca, cotton, OJ, coffee, all closing in the red. What about metals? What's going on here? Massive declines across the board, specifically when we see the rise of the US dollar. I've been saying this over and over again. Inflation expectations are rising higher in part due to the rise of commodity prices, including copper. Well, the Federal Reserve can do some funny business behind the scenes to try to curb inflation expectations. One of those tricks is to manipulate the US dollar higher. When the dollar goes higher, copper starts to trend lower and therefore easing inflation expectations. So far, this is working in pushing copper prices down. It's not working to push inflation expectations down. Now, I understand that the US dollar is also rising due to the sell-off in the stock market and raising more cash. I get it, but there's also an element of manipulation from the Federal Reserve. We saw gold, silver, platinum, copper, palladium all closing in the red. Massive declines specifically for copper and platinum. What about meats? Red picture across the board led by feeder cattle futures, lean hogs, and live cattle futures. What's going on with grains? Big upside day for soybean oil and oats futures. Meanwhile, we saw declines led by canola futures, rough rice, wheat, corn, soybean meal, all closing in the red. You have to also remember one thing, that the rise of inflation is initially good for the economy in terms of stimulating the recovery, but it also at some point becomes a burden because the rise in, say, corn prices, canola prices, that will reflect in the bill that me and you pay in the grocery store. And if our wages don't keep up with inflation, then what happens is the prices gets too high, unaffordable, and we see hunger crisis in the country and we see stagflation kind of situation. So we have to pay attention here because this is an experiment. And the Federal Reserve has to thread this needle very, very carefully. Otherwise, things could get out of hand. We see a massive inflation that leads to another phenomenon called stagflation. So once again, the Federal Reserve has to be extremely careful. Moving on to the big casino, the options market, and let's see what's going on here. We saw a slight uptick in volume, specifically in call options volume, and majority of these options are expiring tomorrow. There is a lot of gambling going on in the market, and when we see massive declines, just like we saw today, a lot of traders are betting on a rebound tomorrow. So they're buying call options expiring tomorrow. That could happen. We could see rebound due to short covering taking profits. Once again, the macro picture is driving down equity prices. We're talking about the rise in treasury yields and inflation expectations that only got worse today, meaning that logically we have more pain to come here in the equities market unless we see something different from the Federal Reserve. So keep that in mind. But back to the casino. At number one, Apple, with about 1 million contracts. About 70% of those were calls. At number two, Tesla, with about 850,000 contracts. About 52% of those were calls. And at number three, Palantir, with a little over 560,000 contracts. About 81% of those were calls. And what about the interesting trades that took place in the options market today? Starting with the ticker CYH. This is for Community Health Systems. Somebody's making a bullish bet here by buying the $10 calls expiration date April 16th with expectations that the name will gain over 14% by then. They paid about 75 cents a piece to enter this trade, bringing the total to about $2 million. Here's another interesting one for the IWN, not M, N as in Nancy. What is that? This is the value ETF, the Russell 2000 value ETF. This is very interesting because somebody's making a bearish bet against the value ETF. We know the value has been outperforming growth and momentum. But somebody here saying, well, guess what? Even value has gotten too high. And perhaps the value now is in the beaten down technology and growth stocks. And they're making a bet by buying the 143 puts expiration date March 19th with expectations that the Russell 2000 value ETF will be down over 6.5% by then. And they paid about $2.50 a piece to enter this trade, bringing the total to about $2.5 million. Here's another interesting one for Apple, the ticker AAPL. Somebody's bidding on more pain to come here for Apple, and this is very interesting because they're buying the 113 puts expiration date March 12th with expectations that Apple will decline over 6% by then. Why is this trade very interesting? Because the level of 113 is a very, very strong support. It could be the destination that Apple is heading toward before bouncing higher. Anyways, they paid about $1 a piece to enter this trade. That brought the total to about $1 million. And what about this trade for AMD? Once again, we're seeing this theme of bottom picking in the beaten down technology names, because somebody's buying the 92.5 calls, expiration date May 21st, with expectations that AMD will rise over 19% by then. They paid about $2.40 a piece to enter this trade, and that brought the total all the way to about $1.8 million. Here's another interesting trade for the RKK. This is ARK Invest Cathie Wood ETF. The name is becoming the poster boy for the sell-off, because Cathie Wood is of course gambling and buying all of these names with no profits, sometimes no revenue, based on future earnings. Well, you know the story. When yields rise higher, her theory becomes scrambled eggs. Somebody's bidding on more pain here by buying the 100 puts, expiration date March 12th, with expectations that the RKK will decline over 15.5% by then. They paid about $1 a piece to enter this trade, bringing the total to about $700,000. And here is the trade of the day, the big one, with the ticker SMH. This is for the semiconductor ETF. Somebody's saying, look, we're seeing a sell-off in the market, but don't forget that we have a chip shortage. The chip shortage will be good for these semiconductor names. So while we might see more declines to come for the semiconductor names, I bet in a few months' time, SMH and chip names will recover and trade higher. This is at least the bet this particular trader or traders are doing. By buying the 240 calls, expiration date May 21st, with expectations that the SMH will gain over 8% by then. They paid about $8 a piece to enter this trade, bringing the total to about $5 million. Moving on to the headlines that shape the day, starting with macro news. In the morning, we received U.S. factory orders. Here it is. U.S. factory orders were up 2.6% in January, further indicating higher inflation. U.S. factory orders rose 2.6% in January as manufacturers continued to lead the way for the U.S. economic recovery. Economists polled by the Dow Jones Wall Street Journal had forecast a 2.3% gain, so we exceeded expectations here. Once again, good for the economy, bad for the market. Why is that? Because the market has become a cocaine addict from the QE operation from the Federal Reserve. The market could care less whether we have a pandemic, civil war, nuclear strikes, asteroids, World War III, World War IV, World War Deluxe. It doesn't matter. The market cares about one thing, the cocaine. What is the cocaine? Fiscal and monetary liquidity. So long as that keeps flowing, the market goes higher. But if we have higher inflation that is pushing treasury yields higher, well, the Federal Reserve at some point will have to stop the cocaine operation. Otherwise, inflation will get way out of hand and we will explode the economy. Back to U.S. factory orders. Orders for durable goods made to last at least 3 years climbed an unrevised 3.4% last month. Orders for non-durable goods such as clothing and groceries rose a slower 1.9%. Here is more. U.S. factory orders surge, but business spending on equipment slowing. Why is that? Because costs are starting to rise significantly. So manufacturers are having trouble finding and paying for equipment, another indicator of high inflation. Then, per usual, we receive the weekly jobless claims. Here it is. Weekly jobless claims rise less than expected. The U.S. Department of Labor reports 745,000 Americans filed initial unemployment claims last week, up 9,000 for the previous week's revised total, below the expectations of 750,000. Continuing claims fell by 124,000 to just under 4.3 million for the week ending February 20th. What does that tell you? Once again, inflation rising higher, the economy is getting hotter and hotter by the day, but unemployment remains sticky because you cannot throw more money on this problem and solve it. It has to take its course. The divorce between inflation and employment will create stagflation. inflation in the economy, but nobody's paying attention right now, including the Federal Reserve. Speaking of, here is the main event of the day. Interview from Jerome Powell with the Wall Street Journal. Jerome Powell warned that the Fed would not sit back and let the financial market conditions tighten, will be patient with higher inflation expected this year. What does that mean? He's telling you, I'm not going to do anything to lower inflation expectations. Matter of fact, I am in denial, and I still believe that inflation is not that high. My Fugazi formula says that inflation is only at 1.5%. Meanwhile, you and I know that inflation is surging rapidly. Whether we're talking about gasoline prices, the prices we're paying at the grocery store, rent, mortgages, etc., increasing rapidly higher. But Jerome says, not to my limit yet. Once my formula starts to show 2% or more, and remember, he says it has to go over 2% persistently. It has to stay there for a while before we do something. And we know that the 2% in Jerome Powell's formula is equivalent to 5% in reality on the ground. So watch out here. Inflation will destroy the average American household. Jerome Powell is clueless. And he has no idea what he's doing. And by the way, what does that mean for the equities market? He's pretty much saying, I'm just going to ignore the problem. Well, the bond vigilantes are going to blow up this market because they're saying, okay, Jerome, continue to deny the problem. Continue to deny that inflation is a problem. And here's what we're going to do. We're going to push yields. If 1.5 did not scare you, watch this. We're going to push it all the way to 2%. And let's see what you're going to do, bitch. And we know at that point, when we reach 2%, it's bye-bye market. Continuing. And pay attention here, because here comes the confusion. Just to illustrate for you that Jerome Powell is either drunk, confused, or that he has no idea what he's doing. Federal Reserve Chairman Jerome Powell reaffirmed in the Wall Street Journal interview Thursday his intentions of keeping central banks' easy money policies in place until the labor market improves much further. So he believes that the easy money policy will magically trickle down to the unemployed and recover employment in the economy, ignoring the fact that the easy money policy will only contribute to higher inflation. There is no guarantee that the easy money policy will actually recover employment. So the guaranteed thing here is inflation will go higher, unemployment may or may not recover with more easy money. There is more. Here's the confusion, by the way. Remember, he just said we're not going to stop the easy money policy until we recover unemployment. So here he is. Fed Powell, highly unlikely to reach max employment in 2021. So you're saying that you're going to flood the market with another tsunami of liquidity, and yet we're not going to reach maximum employment. Then what is the point here? Because the more money you throw at the problem, the more money you print out of thin air and flood the market with, the higher inflation will go. This guy is just way out of touch. And he continues in this path, in this very misguided path, which will end in disaster. And then he goes on and says this. Fed Chair Jerome Powell says there is a good reason to expect job creation to pick up in the coming months. So wait a minute. Is it going to pick up or is it not going to pick up? And we're not going to see max employment in 2021. Oh, I get it. Employment will recover, but it will take a lot of time to reach full employment, meaning that Jerome Powell is saying, I will continue with the easy money policy to infinity and beyond until I reach, quote unquote, my goals. Of course, publicly, he says that his goal is to recover max employment. But we know that in reality, his goal is to continue to prop up, preserve, protect, and inflate the assets of the wealthy, stocks, and real estate. But now Jerome is in trouble because there is an unintended consequence of that we're seeing in the market right now, where yields are rising higher, and all of a sudden the quote-unquote assets of the wealthy in specifically growth stocks, technology stocks, are crashing. So we will see what kind of pressure they're going to put on Jerome Powell in the next few days and weeks. For now, he's doing nothing. If it gets worse, you bet they will force him to do something about it. More statements from Jerome. Any change in QE would need actual progress in our quote-unquote goals. Says it will take some time to achieve substantial further progress, meaning infinity and beyond. Let inflation rise higher, let it blow up the entire economy. Who cares? Here's more from Powell. Bond yield surge, notable, and caught my eye. Oh, you think? You know what caught your eye, Mr. Powell? Oh, yeah. And here is the result. All of the confusing statements from Mr. Powell. Fed Chair Jay Powell did not say last week's move in U.S. yields was disorderly, signaling that the central bank did not intend to take additional measures to suppress the recent sell-off. The result, yields swing higher. So once again, what I got from Jerome's interview today is short the hell out of this market, because I'm not going to do anything and yields will probably surge higher all the way to 2%. And you and I know if we go to 2%, it is a goodbye market. Perhaps the only sector of the market that could, keyword could, outperform, perhaps financials, maybe gold will make a comeback. But other than that, if we reach 2%, even energy will suffer. Because remember, a lot of these energy companies are zombie companies, heavily burdened with debt. If interest rates continue to rise higher so quickly, we're going to see the other nightmare scenario. You think this is bad? You think the current sell-off is bad? Think again. If yields go to 2% and beyond so fast, meaning by the end of the month, perhaps April, we will see the risk of bankruptcies start to loom. That will be the big one. Moving on to sentiment news, starting with Mark Cuban. You know, Mark Cuban lost his mind after the whole GameStop saga. He encouraged diamond hands. People lost a lot of money because of him. And the man completely lost his mind, and now he's just a parody of his past self. The Dallas Mavericks will begin accepting Dogecoin for purchases of both tickets and merchandise. Mark, what the hell happened to you? Moving on to the SPAC mania. Well, the chickens are coming home to roost, baby. The SPAC mania is coming to a tragic ending. Here it is, an index tracking SPAC stocks is down about 20% from its February peak. All the SPAC maniacs, the SPAC generation of investors who are buying empty shell companies, they don't even understand what the structure is. Well, now they're getting a dose of reality. And by the way, where is their god? You know, SPAC Jesus, Chamath Predatoria? He's nowhere to be found. He already took your money, and he's laughing all the way to the bank. What about Davey Barstool? Here's Davey Barstool, the fund which has been promoted by Barstool Sports founder Dave Portnoy, follows an index that uses AI to scan online sources. And the ticker is BUZZ, Buzz. And Buzz was down big on its first day of trading. Wrong time, Barstool. The party is already over. What about the ARK mania from Tesla witch Cathie Wood? Here it is. RKK inflows really started to accelerate December 1st. The VWAP from that date is 137.5. The majority of volume now significantly underwater, meaning that if you gave your Christmas money to Aunt Cathie Wood, guess what? She went to the casino and she blew it up. You lost your money. She continues to dig herself deeper and deeper and deeper. Perhaps we're seeing the whole ARK mania coming to an end. And by the way, who told you that? Not just me, but The Big Short in a tweet reminded you of all of the internet funds back in the dot-com bubble, and these funds were the hottest thing ever during the bubble, scoring 200, 300, 400% gains. They all came down to a crashing end. And the only winners were these fund managers. They walked away with millions, if not billions of dollars, but the investors chasing the mania in these funds lost all of their money. This is exactly with Tesla witch Cathie Wood. Follow her to the slaughterhouse. Here is more from the ARK mania. Short sellers appear to smell trouble brewing. According to one trader, the borrow rate of ARK's innovation ETF, ARKK, reached 19% yesterday. If this is true, the party's coming to an end. A tragic ending for the Cathie Wood story. And the donkeys who followed her and made an idol out of her. Meanwhile, her whole investment strategy is, let me see what the Holy Spirit is going to whisper in my ear. I'm waiting for tickers from the Holy Spirit.
2012, it's sunny days that I have epiphanies. So I walked into my house in August of 2012, and it was very quiet, which I have 3 children and lots going on all the time. And I realized I was going to be alone for 2 weeks, all alone for the first time ever in my house for 2 weeks. And I wasn't happy about it. I wasn't sad about it. But what happened is this. The Holy Spirit hit me over the head with a business idea.
Faith-based investing, gambling, buying random stocks with No profits, no earnings, no revenues. What do you expect gonna happen here? Oh, but Warren Buffett and Charlie Munger, they're too old, the dinosaurs. They don't understand the new generation and the future. Give me a break. The same donkeys said the same thing back in the dot-com bubble, and Buffett and Munger outlasted all of these morons throughout the decades and decades of investing. Why do you think they lasted this long? Because the Buffett-Munger style of investing is based on the numbers. It's not based on which ticker the Holy Spirit is going to whisper in my ear. Moving on to the heat map analysis, and let's see what's going on here. What is the theme? Can we extract anything from today's activities? Well, the obvious is lots of pain in the technology/momentum side of the market. But we also saw pain financials, industrials, materials. What is the explanation behind that? Why are financials now going down when they are supposed to be a beneficiary of higher yields? The explanation is it could be profit taking, that certain investors are believing that maybe we've overdone it here and we need to take some profits to raise cash, either to sit on the sidelines and wait for the uncertainty storm to pass away, or perhaps to buy the dip in the beaten down technology names. We will see the explanation very, very soon. We know why materials are down. Materials are down due to the rise of the US dollar. Energy has its own tailwind, but I bet that pretty soon we will see profit taking in energy names as well. The big question is, all of this cash we're raising from taking profits from the energy, industrials, financial, materials side of the market, the inflationary trade, taking profits to do what? Are we waiting to buy the dip in the beaten down technology and growth names? Or are we starting to feel that perhaps yields are going to rise too high and we will see an overall crash in the market and we are trying to step aside before the big storm hits? Once again, are we raising cash to buy the dip, or are we raising cash because we believe that the storm will intensify and it will hit the entire market with no sectors spare? That is the $1 million question, and the answer will come very soon. My guess is, why would you raise cash to buy the dip in technology and growth names when we know the yields are going to continue to rise higher and higher? And we still have a lot of froth left in the technology and growth names. So perhaps I'm leaning toward we're about to see a big correction that will hit the entire market altogether. That could be the explanation. But here is something else to think about. Why is Google and Facebook closing in the green today? This is the biggest part of the mystery in today's activities. Are they signaling that perhaps we're going to buy the dip in technology names? That could be. But what we know is that among the big FANG names, Facebook and Google are the ones that can be considered as value because they're all overpriced. But in terms of valuations, Facebook and Google have better valuations than, say, Apple, Microsoft, Amazon, even though Apple went down big and its valuation is starting to look a little better. We will see. This is the mystery. We're trying to read the tea leaves of where the market is heading next. Moving on to the charts analysis, starting with the SPY 15 minutes chart. We talked about the head and shoulder formation that is supposed to take us lower. We talked about several destinations. Number one is closing the gap at 383. We did that and we bounced a little higher before resuming the sell-off. Destination number two, closing the gap at 376.76. We went over there, closing the gap, bouncing slightly higher before resuming the sell-off once again. And today we revisited and stopped at the support line of 374. So where is the next destination? To answer that question, let's zoom out and visit the daily chart of the continuous contract of the SPY. We've breached the support of 3,862. In addition, we have breached the support of the yellow trend line, which happens to be the upper limit of the trading channel. Now what? Either you're going to climb back the trend line, and that should happen by tomorrow, Friday. You got 1 day to climb back the trend line. Otherwise, the inevitable destination is 3,600, and that will be a big decline from a percentage point perspective. But all in all, going back to 3,600 will take us back to the same levels we were trading at back in December. So all in all, nothing happened here. Even if we go back down to 3,600, nothing happened. we're back at the same levels we were trading at back in December. So if you're talking about a crash, we haven't seen anything yet because this is not a crash at all. This is just a mini panic, a start of something. It could morph into a crash depending on how the Fed is going to handle this going on. Let's say yields rise all the way to 1.6, 1.65, etc. We see the SPY, the S&P 500, dropping all the way to 3,600. Will the Federal Reserve intervene at that point? Would it be enough for them? Or will they stay the course? And if they do, the yields will surge higher all the way to 2%. We will see the S&P 500, in this case, the futures contract, dropping below 3,200. We'll take it one day at a time. Tomorrow, the chart has a mission to climb back the trend line. Absent of doing that, we're going back to 3,600. Moving on to the cues. What do we see here? I pointed out for you the bear flag formation earlier in the week, signaling lower prices to come. We had the destination of closing the gap at 317. That did not work. We went lower. We had the level of 313. That was a very important level to defend. We went back and forth, and finally today, 313 was broken. We went all the way down to yet another very important support level at 308.5. We bounced slightly higher. If we clean the chart just a little bit and zoom in just to show you and illustrate for you what I saw in today's activities. We went all the way down to 308.5. We breached below that level, recaptured it, everything was looking hunky-dory. I was looking at what? 313. I was waiting and waiting for the cues to recapture 313 because if it did, that would have been a buy signal. Buy the dip via call options, etc. But what we saw is a reversal before reaching 313. When you reverse in any chart, before reaching the important destination, that is a very ominous sign. For me, that was a sign to bet against the cues, and right away, you saw the chart flushing down all the way to the next support level, 303.35. We closed above that support line. Now what? Significant weakness, and the next destination is 299. Let's say that we flush lower during the overnight session. Where are we going to go? To answer that question, we need to zoom out and revisit the daily chart of the continuous contract, the Nasdaq. We went slightly below the support line of 12,408, yet we managed to close above it. So the next task is tomorrow morning is to reclaim 12,766 support level, now resistance. If you don't do that and you start flushing right away, we have 12,027. That would be the next support. And if that support is broken, then we're going down all the way to the yellow trend line, the major trend line, and that would be about 17% correction from the top. Moving on to the IWM, small caps. What do we see here? 15 minutes chart. Yesterday we saw the bear flag played down, creating another bear flag, and the expectations are that we have lower prices to visit for the IWM. To figure out these prices, we're zooming out the daily chart of the IWM. We lost a ton of momentum on RSI and MACD perspective. And now we have several support lines to look forward to. Number one, 204.5. If that doesn't hold, we have 196.5. If that doesn't hold, we have the strongest support, 191.5. And that should hold at least for the short term. But remember, the IWM has been rallying impulsively all the way back since September. And it is time for that impulsive rally to come to a correction. And the correction will be as violent as the rally was. So don't be surprised here if we flush right away all the way down to 191.5 and perhaps breach that level to the downside. What about the Dixie, the dollar index? We talked about a bull flag formation that played out today, and the destination here is the resistance level of 92. The dollar going higher, what is that going to do to gold? Not so good. Gold flushing down significantly. But here is what happens when you try to read the tea leaves. We have a critical support level, a very strong support level for gold at 1675. Now, will that coincide with the resistance level of the US dollar at 92, meaning the US dollar goes all the way to 92 and then starts to reverse lower, and then we see hand in hand gold going down to 1675 and then bouncing higher? This is exactly what I'm watching for in tomorrow's session. Because remember, if inflation expectations are going to rise higher, that is supposed to be good for gold. Gold is a proven hedge against inflation, but it has been underperforming due to the rise of Bitcoin and the US dollar for the last few days. If we see a bottoming formation in 1675, perhaps that would be the entry point to buy gold. Moving on to copper. We talked about two scenarios for copper. A bullish one where we saw an ABC formation that is supposed to take us higher, that is out of the window now. We also discussed a bearish scenario where copper is going to go down to revisit the trend line. That would be about 13% correction from the top. It looks like we're heading toward the bearish scenario. And once again, reading the tea leaves, will copper go down to the trend line in yellow right in front of you in the chart, hand in hand with the US dollar reaching 92, the level of resistance, then reversing lower, and we see copper bouncing higher from the support of the trend line, and that would be an opportunity to buy copper. It certainly could be. And what does that say for the broader market? That the US dollar is reversing from 92. Does that mean the worst is over? We have a short-term bottom at least? I'm just trying to read the tea leaves. Moving on to the big boy, the TNX, 10-year Treasury yield. We talked about another bull flag that is playing to the upside. And it doesn't look like the yields are going to stop here. It looks like yields are heading to the next destination. The next destination is 2%, as extreme as that might sound. But look at how fast we went from 1% to 1.5%. What says that we're not going to go to 2% with the same velocity? Specifically when the Federal Reserve came out today and said, we're not going to do anything regarding curbing the rise in yields. What about the VIX, the volatility index? Surging higher today, facing the resistance of 30.5 and closing below that level. Recocking the gun, readying for another move higher. At least this is what it looks like from my perspective. Breaking 25, the support, and then you know that we are done with this leg of volatility. Moving on to Apple. What do we see here? 15 minutes chart. We talked about the importance of 125. Once we got rejected and started to trend lower, I placed a short against Apple, and the destination was 120. We went down to 120 today, and I closed my shorts. Now what? The chart is just hugging 120. You gotta bounce from that level. The 120 level is supposed to be strong support, so Apple has to bounce back from this level tomorrow. If it doesn't, we have to go to the daily chart, figure out the next destination. We do have a minor support line at 117. That might not hold at all. And then we have 113. 113 is the strongest support, and it should hold. So this is the destination right now that I'm looking forward to. 113 if we go to the downside. And you'll know right away in the morning. One or two scenarios. Number one, we open flat and we start flushing down, reaching 120. If we breach 120, then you know the inevitable destination will be at least 117, if not 113. However, what if we gap lower overnight and we open down in Apple and we open at the level of 113? That would be a good level to buy Apple at, expecting at least a short-term bounce. Moving on to Tesla, aka the souffle. And the souffle is not doing so hot, so we finally reached my target of $5.99, about 34% correction from the top. We didn't actually go to $5.99. We went almost to that point, but good enough. So I know your question. Are you buying now? Because you said that you're going to switch from puts to calls if we get to $5.99. I tell you what I did. I doubled down, baby. Why is that? Because Papa Jerome told me to. Papa Jerome said today he's not going to do anything about the rise in yields and go ahead and short the hell out of this market. And this is exactly what I did with Tesla. I closed my March put options and I rolled further all the way to April. So where is the next destination here for for Tesla? Could be a lot of pain here. We could go down all the way to close the gap at around 400. Once again, you have to remember this. Tesla is the poster boy of this whole crisis of rising yields. The donkeys push this name higher because they like Reverend Elon Musk, and whatever comes out of Reverend Elon Musk's mouth is gold to them. They care not about the valuations, or the price, or whatever. They're investing in Reverend Elon. Reverend Elon is nowhere to be found right now, and reality is hitting the market. Higher valuation names will have to face a reckoning. And it is not out of the norm if we go down all the way to 400 in Tesla, if not lower. You have to keep in mind also, what if we hit margin calls? Because the Robinhoodists and the likes are gambling via margin borrowing. What if we get a lot of margin calls starting, say, tomorrow? Well, one of the widely held names among the retail crowd is Tesla. And if your broker has to sell something to cover for the margin, Tesla's right there. So we're expecting more pain for Tesla here. $5.99 would have been a good level of support if Jerome Powell said anything, any hint that he is willing to control the yield curve one way or the other, at least to tamper down inflation expectations. He did the opposite. Jerome totally blew it today, and he's telling me to short the hell out of the market. So this is exactly what I'm doing. Moving on to the conclusion of this video. Once again, the market started the day anticipating that Jerome Powell will finally wake up and realize that inflation is a big problem, and pouring more money, more liquidity, more cocaine into the economy is not going to recover the unemployment picture. We have what on the docket tomorrow? We have the jobs report, and it's going to be very important to watch. If they're going to cook the books to rescue the market, then they have to show us a bad number indicating that, you know what? Jerome Powell is right. Look at unemployment. It's still very high, and it requires the Federal Reserve to continue the easy money policy, and all of these inflationary fears are just overblown, because we haven't even recovered the employment picture, and it's actually getting worse. And therefore, inflation expectations go lower, yields retreat, and the market recovers. I'm not saying that's going to happen, but that is what the bulls are looking forward to. I think it's a lose-lose situation. Remember, good news or bad news for the market these days, because they will feed inflation. So if we have a blowout number in the jobs report, that would be bad for the market. But is bad news good news for the market? We don't know anymore. On one hand, I just explained to you that if we get a bad number, perhaps inflation expectations will go down and yields will retreat because the road to recovery is too long. But what if the market says, wait a minute, we have a bad number here. That means that the federal government and the Federal Reserve will continue to spend even more, and more spending will contribute to more and more inflationary fears. It's a lose-lose situation. Let's see how they're going to cook it tomorrow. But either way, today was a confirmation from Jerome Powell telling us short the hell out of this market. I don't know what other explanation you got, because he pretty much gave the green light for bond vigilantes to push yields even higher. That is a message saying short the hell out of the market until and unless he does something tangible regarding inflation expectations. But the moral of the story is, this guy you're listening to right now told you that the morons are gambling in the stock market, and their excuse is, but Papa Jerome got our back. Papa Jerome just stabbed you in the back.